Seasonals, there are certain businesses that have seasonal employees. There's special definitions for seasonal employees. Seasonal employees generally are not required to be counted, and there's a certain definition for seasonal employees. If you have that situation, you're going to want to investigate that to determine how that fits you. Let's look at a specific example. We've got here 40 full-time employees that work 30 or more hours on average, 25 part-time employees that work 15 hours on average per week. So that full-time equivalency calculation says take the 25 employees, 4 weeks in a month, so you do that math, and you get 1,500 hours. You divide that 1,500 hours by the 120, you get 12.5 full-time equivalents. For this calculation, we drop the fraction. We have 40 full-time employees. We have 12 part-time employees that on a full-time equivalency adds 12, so 40 plus 12 gives us 52. They're over the 50 threshold. This employer is required to provide health insurance. Required to provide health insurance for those 40 full-time employees.
Is this test done annually or monthly? Or?
This test it's a monthly test. It's
an ongoing test. There's going to be a stability period and a measurement period that you're going to have to keep track of forever moving.
So yeah, this is you're going to have to pay attention to this test all along, each and every year. Now, some folks, my first question was, we have many clients that have several businesses. How does this work? How do I determine whether or not I'm over the 50 threshold? If let's say I own 3 businesses, and I've got 20 employees in one business, 20 employees in the second business, and 20 employees in the third business. 60 employees altogether. They're all full-time. Do I have to group those together, or is the 50 measured based upon each separate company? Well, if it's a controlled group as defined in, can I move this? If it's a controlled group as defined, and these are retirement plan provisions. If I own 100% of those 3 businesses, all those businesses are going to have to be aggregated. And so I would have to provide health insurance for each employee of those 3 companies, because in the aggregate, I've got more than 50 employees. Okay. But then the penalty amount is determined on a separate company basis. And we will talk about how that works. So, once we're required to provide, we know we're required to provide health insurance. The government says we have to provide coverage for at least 95% of our employees. So we have a little bit of a 5% threshold, but you're essentially, and I think from an insurance company standpoint, that 95%, I'm interested in what your view is on how that will be applied. But it gives us a little bit of grace in that analysis. So let's look at the penalty. How does the penalty work? Here we're assuming that there is no coverage required, because there's a different penalty approach if no coverage is provided, and then another penalty approach if coverage is provided and it's not considered to be affordable. If there's no coverage, the penalty amount is $2,000 per employee, but we're essentially allowed to take our total number of employees, subtract 30 from that, and then apply that $2,000 per employee penalty on the number of employees we have in excess of 30. And so in the example that we had 40 full-time employees. We were over the 50 when we considered the full-time equivalents. So we have to provide coverage for the 40. If we don't, the penalty is based on that 40 less 30, 10 employees times 2,000, the penalty to the employer would be $20,000. And so for an employer that's only concerned about the dollar and cent cost of health insurance coverage, they will look at that $20,000 cost and say, how does that compare to the cost of providing health insurance to those 40 employees? And I promise you, the 20 grand will be less. And so there'll be some employers that will say, I'm done. I'm not providing health insurance coverage. And that's what this example shows. No coverage. There's a different penalty that's as much as $3,000 per employee if and there's no minus 30 rule for this, if the employer does not provide affordable coverage. And here is the first test. Remember I said affordable coverage is determined on one measure if the employee's contribution to the cost is more than 9.5% of the employee's income. And so you get then into a question of how is the employer to decide what the employee's income is? And they've given us 3 safe harbors for this determination. The employer can simply look at the amount of wages that's on a W-2. There's a rate of pay safe harbor, and then the premium amount expected to be paid by the employee can be based upon the federal poverty level income. And so if we're using the W-2 safe harbor, and these are choices that the employer can make in this determination. The employer is looking at the wage amount in box 1 of the W-2 and taking 9.5% of that wage amount, and if the contribution that's expected of that employee is greater than 9.5% of their W-2 amount, then they're going to be subject to the employer is going to be subject to a penalty. The rate of pay exception, or safe harbor I should say, basically says you can, for hourly employees, you look at what the hourly rate of pay is, times 130 hours in a month, because these are monthly penalty determinations, and you determine the amount of income on that basis. For salary employees, you just take what their monthly salary is and apply that 9.5% to what their monthly salary is. And then the federal poverty level, these in many cases will be even a lower amount of income, and will, as a result, the expected contribution to the employee will be a lower number. And so I would expect the federal poverty level safe harbor probably won't be used all that often, is my expectation. So what is the penalty? The penalty amount, if the employer is not offering affordable coverage, is $3,000 per full-time employee. Now, this only applies if that employee applies for and receives that premium credit that I spoke of. So you have an employee that is getting a credit from the government to help subsidize the cost of their health insurance. That determination and these penalties really are going to be assessed like the year after the year in question. And so in 2014, the government's not going to have all the information they need to determine whether or not a penalty applies for 2014 until 2015, after the year is over. And we'll talk a little bit more in a bit about how that will be paid. The penalty amount can be no more than that $2,000 per full-time employee amount. There is a cap. There's a cap on the penalty when it's not affordable. Now, the IRS has said that they will contact employers when they believe the employer has a penalty. And they will give the employer then an opportunity to refute that determination. Remember, it'll be after the fact, it'll be after the year end, because the government won't know what that premium credit is until after the fact. And so, when we look at this, and we look at employers that have financial statements issued, one of the questions that your auditor may ask you is, do we have a penalty we have to put on your books as a liability? So there will be questions that we, as in doing an audit or a reviewed financial statement for you, we will have to determine whether or not there's an unrecorded liability relating to these penalties that the employers should be booking on their financial statements. So it's going to raise that issue sooner than when you're going to get a notice. And so, and one of the things that I think I missed mentioning is that in determining whether the number of employees that we have, you're looking at the year before the year coverage is required to be provided. So for the 2014 year, when this first goes into effect, we're looking at the employee numbers in 2013. We're looking at how many full-time employees you have in 2013. This is one of the reasons, one of the big reasons, that we can't wait until 2014 when this applies. We need to start thinking about this now in order to determine whether or not we are subject to these mandates. Also included in this law is our non-discrimination rules. Before this law was passed, employers that provided fully insured health plans could arbitrarily decide to cover this employee and not that employee. Could arbitrarily provide that I'm only going to provide health insurance for my top paid group, and the rank and file employees we're not going to cover. I think the health insurance companies have issues with that, but from a tax point of view, we could discriminate. A number of years ago, the government passed a law, Section 89. I remember it well. It didn't last. That section or that proposal or that law that was passed was going to provide non-discrimination rules with respect to fully insured health plans. That law was repealed almost 6 months after it was passed because there was concerns with, I think, it's being able to enforce it. Well, the Obamacare includes a non-discrimination rule. And that non-discrimination rule goes back to plan years beginning after September 23rd, 10. So we're already there. But the government has already said, and this also makes me nervous, the IRS, the DOL, the Department of the HHS, they've all said we're deferring that non-discrimination requirement until we issue final guidance. My first question is, why do 3 government agencies have to be involved? That tells you that the cost of administering this is going to be significant. And so what happens? Let's talk about what the rules are. Non-discrimination rules apply if coverage is provided to highly compensated employees, as defined here, and not to rank and file employees. And not highly compensated employees include the 5 highest paid officers, those that own 10% or more of the employer, and the 25% of the highest paid employees. You cannot discriminate in favor of these employees.